This is Dr. Kent Gregory, and welcome to the final installment of the discussion of Chapter 4 of Mutual Funds and Other Investment Companies. And this one will focus on hedge funds. And this is coming from Jordan, Miller, and Dolvin's Fundamentals and Investments, ninth edition from McGraw-Hill 2020. So hedge funds are very interesting, and there are certainly some complexities to them that make them that much more interesting. But first, some basics. Like mutual funds, a manager of a hedge fund invests a pool of money obtained from investors. They are not accessible by the general public, meaning the hedge funds. They accept only qualified investors. And to be qualified, you must be an institution or individual with a net worth of about $1 million dollars or, say, recurring income of $200,000. This implies that you're relatively financially savvy. So this allows, in turn, hedge funds to avoid many of the restrictions and regulations that are placed on mutual funds. And hedge funds can also limit their number of investors to no more than 100 institutions or individuals. They can sell short or use large degrees of leverage, unlike mutual funds. They're not required to maintain any specific level of liquidity or diversity. And this liquidity issue leads us to this next point, in that they don't redeem shares on demand. They typically designate liquidation dates, like say once every quarter or less often, and they require advance notice. And the reason is the fund might have investments in a certain amount of illiquid assets. And then, as we mentioned above, hedge funds have limited regulation. So the general management fee of a hedge fund is about 1 to 2%. But then on top of that, the manager is paid a special performance fee. So the performance fee is often in the range of 20 to 40% of profits realized by the fund's investment strategy. And the most common fee structure is 220, which is shorthand for a 2% annual management fee and 20% of the profit of the fund, a 20% performance fee of the profit of the fund. So the positive of this is that the performance fee incents the manager to earn as much profit for the fund as possible. The negative is illustrated by this particular situation. If a manager knew there were going to be losses, he or she could try to absorb as many of those losses as possible in 1 year to enhance his or her position to make a larger profit the following year. Now, there are many funds have requirements known as high water marks. And according to the high water mark, or if there is a high water mark, this prevents that negative from happening. So the manager is only going to receive a performance fee if and when the fund value is higher than the previous highest value. So that's the purpose of the high water mark, to prevent that possible negative scenario. So hedge funds, there are essentially 6 investment styles, and we're going to lump in a 7th into that. The uh, the first one is market neutral, uh, aka long short funds. So the goal is to offset risk by holding opposite positions in pairs of securities. So managers will take long positions in a set of securities that they believe to be underpriced. So they're going to hold these for a long time, relatively speaking. And then the managers will also match these positions with corresponding short positions in over or perhaps even fairly priced securities. So if constructed well, the fund will make matter no matter how the overall market performs. And the expected volatility of a market neutral fund is low. Then the next style is arbitrage. So managers of an arbitrage fund will look for a mispricing in relationships between securities, and it's a mispricing that shouldn't happen. So more specifically, managers will look at pricing relationships for securities offered by the same company or for investments across time or country. An example, a manager might buy convertible bonds of one company and sell that same company's, and short sell rather, that same company's common stock. The expected volatility of the arbitrage style is low. Then there are distressed securities. So this is where managers invest in securities offered at deep discounts because of company-specific or maybe even sector-wide distress. An example is managers might buy securities of firms facing bankruptcy. The expected volatility here is low to moderate. Then the next style is macro. So managers try to profit from changes in global economies brought about by government policies that affect interest rates, currencies, or commodities. And managers will use leverage and derivative securities in this type of fund. The expected volatility is high. Short selling. So managers of this type of hedge fund will only short sell. And they'll also use leverage through margin. And the expected volatility here is high. Then there's the market timing fund. So managers try to identify trends in certain sectors or overall global markets. They'll take concentrated positions and use leverage to increase the fund's exposure, and this could be positive or minus, to the predicted movements. And the expected volatility here is high. And then there's also a type of fund called a fund of funds. And this is what I'm going to call the seventh style, although it's not really a hedge fund in and of itself. It's actually an investment company that invests in hedge funds. So it's almost like a mutual fund in that it holds a bunch of funds, and in this case, they're all hedge funds. But what this does is it allows for the fund to be diversified. And another positive of this is that the fund of funds manager likely has, and not more than likely, I mean, he or she certainly has experience in selecting hedge funds. However, one thing to note is that the fund of funds will charge its own fees on top of the fees charged by the hedge funds themselves. Well, that concludes not only chapter 4, but also our discussion of hedge funds. I hope you found that enjoyable and learned a lot. Thank you much.